Now coming to the insurance sector, so there are two terms I would like to highlight in the insurance sector. One is insurance density. Insurance density means it represents the ratio of premium. Premium is basically the amount which is given regularly by the customer to the insurance company. So it is a charge, it is a basically kind of regular expenses, regular amount which is given by the citizen to the insurance company. So ratio of this premium to the population, this represents density. So it is density in India, which was US dollar 11.5 in 2001, it reached US dollar 74 in 2008. Represents, so it represents that density is increasing. This is very good thing, because now people are becoming more and more aware about the insurance, and they want to invest more and more amount of money, more and more amount of money in the insurance sector. The insurance penetration means the percentage of insurance premium to the GDP. So premium to GDP, it has been declined. It is declined, right? Now you can see the question. This is the practice question. Consider the following statements. Number one, the insurance penetration of life insurance has increased from 2011. This statement is right or wrong? The non-life insurance has increased consistently. So here the option B is correct. Option B, that is the statement 2 is correct, and statement 1 is wrong. Now, as I promised, I will also be covering the budget proposals. So if we see from this sector, the budget 2021 has proposed certain very important aspects. Please be careful. These are very, very, very important aspect. What is this? First is the deposit insurance coverage. Deposit insurance coverage. So we have seen in the recent time the PMC bank falling and many other small banks falling. In case the bank fails, the depositors will not do not get their full money back. They get the money to the extent of insurance. That is, if Mr. A has deposited rupees 10 lakh in the account and the maximum insurance amount is 1 lakh, which is the as per the government, so he will get only 1 lakh rupees. There is another person, Mr. B, he has deposited 1 crore rupees. If the bank fails, he will also get 1 lakh rupees, right? So the maximum insurance till now has been 1 lakh. Now the government is showing that per depositor this amount should be increased to 5 lakh rupees. This is very, very good. This will increase the trust of the people in the banking system. This 1 lakh rupees represented the very old amount. It was relevant and appropriate in the very, if we go back to 20-30 years ago, at that time this was appropriate, but as of now, in fact, I say this 5 lakh rupees is also less. This should be at least 10 lakh rupees. People are depositing their hard-earned money. Second, eligibility limit for NBFC for debt recovery under the SARFAESI Act. So this SARFAESI Act is a very strong tool. Under this, the bank officers, they can recover the money in a very fast process. NBFCs are also allowed to use the SARFAESI Act, but earlier the big NBFC were allowed to use the SARFAESI Act. In the recent time, because the NBFC sector is also in the grip of the NPA, therefore the size of the NPA, the size of the NBFC which can use the SARFAESI has been reduced. So now the more number of NBFCs, they can use the SARFAESI Act. Separation of NPS trust for the government employees from the PFRDI. PFRDI is the regulator, right? And this trust is the executive function. So the government is actually separating the regulator from the executive function, so that more and more there can be independence in the management of the trust. Specified categories of government securities would be opened up for non-resident investors. So NRIs can invest into specified securities of the government. FPI limit for corporate bonds to be increased to 10 to 15%. So in India, the corporate bond market has been very poor. We do not have a strong bond market. Because of that, we face the problem in the infrastructure financing, because infrastructure requires long-term financing. For the infrastructure financing, we are dependent upon the banking sector. In the banking sector, the available funds are not for the long term, they are for the short term, because the people are depositing money for 5 year, 10 year. Infrastructure needs the money for the 25 years. For that, we need to have the bond market. Therefore, the government is promoting the corporate bond. It is allowing the FPI to invest into the corporate bonds. New debt ETF proposed mainly for government securities. Now, what is ETF? Exchange traded fund. An exchange traded fund. So basically, we discussed the concept of mutual fund. This is the mutual fund we discussed. Now, these mutual funds, they are not traded on the stock exchange. When these funds are allowed to be exchange traded, when they are allowed to be exchange traded, they are called exchange traded fund, ETF. Very, very simple, nothing special, right? So now in the budget, one special ETF is being created for the debt. So you can see new debt ETF proposed mainly for government securities. So for the government securities, this debt ETF basically will invest into the government securities. It will take money from the common investor, general public, and invest into the government securities, right? The purpose is that more and more government securities can be sold and more money can be raised by the government, because the government want to fund the economy. An exchange traded fund is a basket of securities that trade on an exchange, just like a stock. So main purpose is they are traded on the exchange. ETF share prices fluctuates all day as the ETF is bought and sold. This is different from the mutual fund that only trade once a day. So this is the major difference. Please keep in mind, mutual fund, they trade once in a day, and ETF, they are freely traded during the entire day. So the value fluctuation in case of ETF is high as compared to the mutual fund. ETF can contain all type of investment, including stock, commodities, bonds. They offer low expenses and fewer broker commission than buying the stocks individually, right? This is the complete synopsis I have already discussed, so I don't think that this will make any help to you. Overall, I hope you enjoyed this session. So I will request fast forward my lecture to 2 times and revise this lecture at a very fast speed so that you can benefit. Before I conclude, I will take 5 minutes and revisit the entire session so that you can benefit and you can recall the major concepts. So I am going back to the starting point so that you can recall the entire session. You can actually revise the entire session. So my commitment is that you get the major benefit from this session. So chapter number 4, we are discussing, we started with the monetary policy. What is monetary policy? So it refers to the use of monetary instrument, and ultimate objective is threefold: price stability, economic growth, and stability of the exchange rate. We have the quantitative and the qualitative tools. Then repo rate we discussed, it represents repurchase offer, and here the money is borrowed by the bank from the RBI. So here you can see the transaction happening. There are multiple rate, repo rate, reverse repo rate. Reverse repo rate is less than the repo rate. Bank rate, MSF rate, they are higher than the repo rate. There is a difference of 0.25%, which is called policy corridor rate. CRR is kept with the RBI, SLR is kept with the bank itself in the form of cash, government bonds, and the gold. These are the different rates. You can see there is a decline in the rates, which represents the accommodative stance. So right now we are following the accommodative stance. That means the policy rates are declining because we are in the middle of the slowdown. Monetary policy, you can see we are in the accommodative stance. 10-year benchmark, government security yield, government security basically is a certificate which represents the loan given to the central government. 10-year represent the maturity time. Yield means the income which is earned by the investor, and there is a opposite relationship between the government prices and the yield, right? In India, in the first half of 1920, government security yield has been softened because of two reasons. Monetary aggregates, which basically indicate the money supply in India. M0 is the base money, M1 is the narrow money, M2, here we add the post office saving deposit also. Broad money, it represents the time deposit also, and M4 is the largest. As we go from M0 to M4, liquidity is decreasing and quantity is increasing. Here you can see the different terms. Money multiplier, it indicates the relationship between the M0 and M3, right? So it is basically dependent upon the concept of the fractional banking. In India, the money multiplier was very high between this time, and now it is declining. Monetary policy transmission, so the impact of the change in the repo rate upon the common household. It is very poor because of the different reasons. One is that there are multiple sources which the bank have. Financial inclusion is poor, balance sheet of the bank are poor because of the NPA crisis, asset prices are declining after the demonetization, and the competition from the other financial saving instruments. There is a time lag of, there was time lag of 7 months earlier, now it is a time lag of 3 to 4 months, and weak transmission is there because of the rigid saving deposit rate, competition from other financial saving instrument, deterioration in the health of the banking sector, and the poor financial inclusion. Economic survey, monetary transmission, it has been weak in India. NPA, you can see when the recovery of principal and interest is overdue for more than 90 days, then this is called NPA. The impact is upon the profitability and the balance sheet. Schedule means second schedule, which means the bank have the paid up capital of 5 lakh. It is a company and it is operating in the interest of the depositors. The benefit include it can get the concessional credit and it is member of the clearing house. NBFC sector is also in crisis after this crisis in DHFL and the IL&FS. IBC insolvency and bankruptcy code has proved one of the biggest tool as a resolution mechanism. Capital to risk weighted asset, it represents the minimum own fund which the bank should have, so that in case the customers are not able to repay, there can be some minimum amount which the banks can have. Basel III CAR has been fixed at 8%. India scheduled commercial bank maintained CAR of 9%, and public sector bank they have the 12%. In India, the good news is that we are having the CAR of 15.1%. This is the question that we discussed. Then capital market, so here it operates for the long term. In the primary market, the securities are issued and sold. The new ones, in case of secondary, the existing securities are issued and sold. Stock market, in the stock market there are shares trading. The shares also give the ownership right. In case of the bond market, basically it represents a loan. There is no ownership right, but there is a fixed interest cost. Here you can see in case of public issue, companies issuing shares to the multiple shareholders. In case of the rights issue, it is issuing the shares to the existing shareholders. It is giving the first right to the existing shareholders. In the private placement, the shares are sold to the pre-selected individuals. So in a closed circle, the shares are sold and they are relatively unregulated, and they are usually used by the startups. Mutual funds, here it is an investment vehicle where the small and individual investor, they get access to the diversified portfolio which are managed by the professionals. FDI and FII, if it is a listed company, then less than 10% is FPI and more than 10% is FDI. In case of unlisted company, any investment is FDI. Between FDI and FII, we can see FDI is more interested in business, control in the long term. FII is investing into the stock market. They are not interested into the ownership and they are working for the short term. benchmark indices, BSE Sensex, it represents the top 30 companies movement, and Nifty, it represents the top 50 companies in the Nifty. Insurance sector density represents the ratio of premium to the population. Penetration represents percentage of premium to the GDP. In the budget, deposit insurance coverage is being increased from 1 lakh to 5 lakh. Eligibility limit for MDFC and BFC for debt recovery through the SARFAESI Act has been relaxed, and the trust is being separated from the regulator. Government securities are being opened up for NRIs. FPI limit for corporate bond has been increased, and new debt ETF has been allowed. The major difference between the mutual fund and the ETF is that the price of ETF is fluctuating the entire day as compared to the mutual fund. With this, I complete this session. I hope you enjoyed. Thank you very much for listening, and God bless you.